Welcome to the Monopoly Mindset, the podcast where we uncover the strategies to build your real estate portfolio one property at a time.
We're your hosts, Tyler and Tommy, here to share our story of playing real-life Monopoly.
Whether you're just starting out or a seasoned investor, this is your go-to resource for mastering the real estate game.
So grab your board, roll the dice, and let's buy Boardwalk together. Welcome back to the Monopoly Mindset, episode number 29. This is officially the last episode in my current house that I've been in for 4 years. So I know I've been having different setups and stuff, but I'm excited to, be in the new house and the new office and have a cool setup.
What are we going to have? Like a deer hanging in the background, something like
Yeah,
that?
I mean, wedding photos, obviously. Fake trees. I don't know. Some eagle stuff, some hunting stuff. Yeah, I think I want to do one wall like tongue and groove or shiplap. So probably the wall behind my desk. But yeah, that's gonna be lower on the priority list of stuff to do. So that probably will take me a couple months to actually get to that. But my friend Thomas in Vegas, his office is sick. Like he's just been picking up Eagles memorabilia like over time, or all Philly really. So like basically all of his walls are just like Phillies, Eagles, Sixers, like all just like photos and signed helmets and all this shit. I was like, I'm kind of gonna model it based on that a little bit, but
I mean, you've been picking up a decent amount of Eagles memorabilia since every time we go out. I'm pretty sure you buy something.
yeah, yeah. And then I had this Walter Payton uh, hanging photo that I bought when I was like literally 12 maybe, that I still have, so I might keep that. But he was my guy back in the day.
Hey,
But
sports players are sports players. It's all right. You're allowed to have other favorites. I have a ton of old jerseys. I almost thought about like giving to Judy and seeing if she could like cut out like a blanket because I have all these jerseys just sitting in like a bin in my garage. Like I don't really know what else to do with them.
yeah, yeah, I'm sure she could. I don't know how like the jersey material would sew in, but anyway, going on a tangent. So today we're gonna do another topic, and that is basically, should you buy houses cash or leverage them, finance them? Kind of the same ideas, like should you pay off your house early? And as an investor, there's definitely a few different mindsets here, but you've been telling me that you have a friend that's like been listening to Dave Ramsey and is on the Dave Ramsey train and is like, hey man, I want to buy a rental and pay for it all cash, and you're kind of trying to talk him out of it. So
Exactly. So that Ty and I were looking for topics, and I said, why don't we just talk through this one? Because I mean, at the end of the day, Ty and I both love Dave Ramsey. We've talked about him several times. He's pretty much, I think, the reason we both got to where we're at. He's a great foundation when you want to start learning about your finances, how like smart money decisions, and I just kind of joke once you listen to him for 2 to 3 years and you really understand those principles, then you can graduate and start learning a little bit more and kind of get into real estate investing. And that's where Ty and I have made it now. And a lot of this episode, it might sound like we're disagreeing with Dave or maybe agreeing with Dave. At the end of the day, I think we both agree with Dave. And for 90% of the population, if they just listen to Dave Ramsey, they'd be in a much better place financially. And I think that a lot of the times Dave speaks to his population and maybe not to the other 10%. I mean, he acts like he does and he'll talk certain ways to people at times, but I think overall he's really speaking to his following. And if something is a little bit riskier, he doesn't want his following thinking that's okay. And he wants to keep them, you know, with as little debt as possible. Because a lot of the people that are in a lot of debt, the last thing they need is a bunch of more debt.
yeah, I think that he's gotten himself into this character who believes this thing, and he sticks to those principles 100% of the time, but part of me thinks that like he'll say stuff and I'm like, dude, there's no way you can believe that. You're just sticking to your principles. And like I respect that, but at the same time I feel like and disclosure, he's worth like $1 billion. Who am I to tell him, how to about finances? But like he'll say stuff that I'm just like, dude, you just can't believe that. You're just saying that because, it sticks to your core beliefs. And mostly, again, we're talking about leveraging real estate. And like somebody will call in and say, I own like I don't have any debt. I have a mortgage on my primary, which he's okay with, but I have a rental property and I have like 50% equity and like 50% mortgage left over. And Dave will be like, "Oh, sell it. Like sell it immediately until you can buy it cash." And I'm just like, really? Like you really believe that?" But I mean, apparently he's purchased all of his real estate cash and I think he's got over $500 million in real estate, which is insanely impressive, obviously, but
So, like thinking back right now, I don't know if I've made this connection or not. Maybe I've said it in the past, but it was a Dave Ramsey episode that got me thinking about real estate investing. And it was this exact scenario where somebody called in, they had three rental properties, they had probably 60% leverage, they had 40% equity, maybe 50%. Regardless, the guy was just spitting off so many facts to Dave about I'm not selling these properties. I'm making them, making money off of them, and I'm using them to grow like extra cash flow. And like, I think that was really all the debt this guy had. And Dave was just like yelling at him and calling him stupid and telling him that he should. And I'm like, you know what? I actually kind of agree with this guy more. Let me do more research and learn more about real estate investing because it just like the way he described it was like each house I have is a little business that's making me a little bit more money. And even if it's not a ton of money, it's still a business that I'm a part of and it's relatively passive compared to other businesses. And it just sparked that interest in me. And again, that's why I always joke you start with Dave Ramsey and you graduate to real estate investing. And that's 100% what I was able to do.
yeah, one of the things that I believe I had already purchased my primary house, my first house, and then my duplex. But what really dawned on me at one point with real estate is that I compare everything to like if you just invest in the S&P 500. So like I compare everything to a 10% return basically out because that's just set it and forget it 401k like whatever 8 to 10% average over the last 100
Like
years.
you were
So
raised on and grew up thinking and believing, and like even when we had our initial real estate discussions, it was like, no, I can make 10% in the S&P and P and it's going to be this amount. And I was like, yeah, but if you put it in real estate, like it could be this amount. And like that, but that was always your basis of what you went back to was like anything is I can get 10% in the market. I'm just going to put it in the
well,
market.
yeah, and I still do. Like yeah.
Yeah.
But the thing with real estate that hit me one day is that appreciation, we're gonna say 3%. That's like the national average over couple decades or whatever. But it's 3% on the total price, not the percent that you put down. And that was like huge for me because for an investment property, you're putting 20% down, but you're getting 3% on 100% of the property. And then a primary, you're putting 3% down, but getting 3% on the total percentage. So like if just real quick numbers, you buy a house for 100 grand, you live in it, you put 3% down, and then it's worth 103, you just got 100% return based. I mean, obviously quick math, but you just got 100% return based on that 3% on year one. So yeah, we're both big fans of leverage. It helps you grow extremely much quicker than saving up. Like who's really gonna save up in my area rental property will say is 250,000. What am I gonna I'm gonna buy one until you know what I mean? Like it just to me is unrealistic. But the thing that I do agree with Dave Ramsey is we're gonna do some calculations and scenarios at the end and you'll see these all over the internet. They don't include risk. That risk is not part of the calculation. It's just strictly math. And that's his whole point with this whole thing. He's not arguing that mathematically it makes more sense. He's arguing that emotionally And then when you factor in risk, you should be buying things cash. So I'm kind of gonna play a little bit of devil's advocate here, even though I'm very pro leverage. I do want to kind of explain his side of things and how, everybody has their own situation, and it's not like you have to do the same thing for every single property. Like I have a property that I would love to pay off actually, even though I don't want to do that for my whole portfolio. Like, you can pick and choose, and but again, the risk is the biggest kind of elephant in the room when you're running through these calculations.
I agree with what Ty's saying. I think he's trying to paint Dave in a nicer light, and I think Dave deserves to be painted how Dave wants to be painted. And his a part of his argument too is he thinks it's a dumb financial decision, whether he truly believes that or not. Like the smart investor in Ty is like, there's no way that Dave can believe some of the things that he says. But he has definitely been very abrasive and rude to real estate investors. He loves them if they say they pay cash and they're going to buy it cash. That is his truth and his gospel. And for those of you that don't know, Dave Ramsey also bought a ton of real estate when he was going up to 28 or 29. I think he was a multimillionaire.
26,
So 26 years old, he had multi-million dollars in real estate. I believe he was a real estate agent. I mean, he created most of his wealth through real estate, and he loves real estate because of that. However, there was some really weird loans that used to be available. Maybe they're still available today, but they're very scarcely used. And he basically something happened in the market and interest rates shot up and the bank called his loans due, and he was doing a ton of flips and had a lot of like leveraged debt out there, and basically went upside down and had no way to pay all of his mortgages and had to go bankrupt. And because of that, he has this burning desire to tell everybody using leveraged debt is the worst thing you can ever do. And it obviously caused him a ton of pain, and it makes sense why he thinks that. And since he has still loved real estate, he's just changed his ideas on it of, hey, I need to buy it cash so I don't have to deal with the bank and ever have like my asset relying on mortgage payments to a bank that could, you know, cause issues.
Honestly, just what you just said about deal with the bank, I'm leaning more towards buying cash just because like literally you don't have to go back and forth with the bank 100 times, and yeah. Um, but one interesting thing also is you don't have to worry about interest rates, right? Like everyone's talking about interest rates right now. It's like, oh, nothing makes sense because interest rates are high, or I'm gonna buy when interest rates are low. If you're buying cash, literally that doesn't matter to you, right? That doesn't you're not borrowing any money, so it's like you could be buying a bunch of properties right now with high rates, and then when they drop, sell them because the value is going to go up. But yeah,
And also like cash flow. If you're buying cash, your cash flow is typically going to be a lot higher than if you have leveraged debt. I mean, depending on how many houses that you can buy cash. And like the tough part is I'm not in a position to buy 4 or 5 houses cash. You know, if I was in like the next 2 years, yeah, it's a pretty decent option. And like it still gets to what Ty talked about, like, what's that return going to be on your money? And for this example, you'd really be looking at like a cash on cash return, right? If you're going to put $200,000 cash into a property, what's my return on that money going to be versus if I just kind of put it into the market or put it somewhere else? But the one of the things that happens in Ty's market specifically, like he'll look at deals and be like, how the hell is somebody buying cash and paying this price for it? And at the end of the day, if you buy a property cash and you're not leveraging it, you're going to make cash flow on that property pretty much regardless. And so if you're in some sort of retirement position and you need extra cash flow, buying rental properties cash at that point is definitely a great way to increase like your yearly income. If you're only making X from Social Security and living a little bit off of your investments, but like the 4% rule, I would love to see what that would look like if we took a 4% rule of like $1 million. You're living off 30,000, but you bought 2 houses cash. So maybe you split it 50-50. Those 2 houses cash, if you buy brand new specifically, so they should be fixed up for the next 10, 15 years without too many maintenance issues, and you're making 2 grand a month. I mean, you're making more money doing that than living off the 4% rule. So there's a lot of ways that buying cash can make sense, but I think for the average person that wants to grow their wealth, there's no better way than to use the leverage that Ty was talking about earlier. Because if you buy a house for $200,000 and you only put 5% down, you're putting what, 5 grand or 10 grand into a property. So I put 10 grand in, but I'm getting a leverage return on $200,000, which is it's like stealing. I mean, you're making way more money. That $200,000 should keep increasing at 3%, and now you get to take advantage of that 3% return on $200,000 because you put 10 grand into it. And once you save up enough cash and get enough money in the market, those returns will be more significant, and like it'll start to snowball, and like you'll be making more and more money. But throughout my entire journey of all the money I've put into the stock market and that I've put into my 401k, and then the money I've put into real estate, my net worth is significantly higher in all of my real estate transactions than it is in everything I've put into my 401k and my Comcast stock. And sometimes I definitely wish that I just put a lot more into real estate because I see the end game and the value in it, but that's again just talking about real estate.
Yeah, I mean, I think you brought up a good point about somebody that's close to retirement age, and like we are coming from this perspective as somebody that are I'm 29. My real estate career is still extremely new, and we're just in a 100% growth mindset. And as you get older, your risk level starts to go down. Even if you just have a 401k, you start out in all index funds and mutual funds, and then as you get older, you shift a lot of your portfolio into bonds because they're 100% guaranteed but less return. So real estate's kind of the same thing, where right now we're basically like at a point where we're going to take a cash out refinance or a HELOC as soon as we have like a little bit of money to buy something else, right? But if you're getting closer to say 40 or 50, you might not do that on all your properties and like say leave in 50% equity. Because again, it's just that risk factor. Luckily for me, the way that I look at it right now is one, when you buy an investment property and you have 20% down, that's a pretty good cushion in case of like I look at things as like being underwater, right? That's where you're like super risky. If you buy a place 3% down to live in, and then you have a 2008 crash, property values go down 30%, you're, not in a good spot at all. And then you lose your job on top of that, right? You can't sell, you can't make your payment. Like that's where people get into trouble. But I feel like because investment properties make you put 20% down, that's a pretty good cushion that like, are we going to see another 30% crash in 1 year? I don't know. But the 20% makes me feel pretty good, right? Like that the bank is requiring you to have a decent amount of equity in the property. And then the second thing that makes me feel pretty good is that I still invest heavily into my 401k. And so to me, that's like the big risk mitigator in my mind. Not that I want to drain that account. Ideally, I never touch it until I'm 59, but it's there in the back of my mind that if I have 20% down on a rental property and there's a crash and my tenants don't pay and I have to cover that expense for 6 months, whatever, a year, or maybe just until I can sell and like get out of that debt, I at least have this chunk of money that, I'm not gonna completely go bankrupt or like have to file like lose everything basically. So that's how I go about it. I know a lot of investors don't have a 401k at all, which is fine. They definitely should have more cash reserves. I admittedly run super low with like cash reserves, and that's probably because my 401k. But yeah, I mean that's how I look at it.
Yeah, and I think you also brought up a ton of great points. And one of the reasons that somebody might want to purchase in cash is 100% the risk factor of talking about the interest rates, talking about going through the bank, having the bank own your loan. Something could change. What if the tenant moves out? What if you have vacancy? I mean, there's a lot of fear factors in owning real estate, right? Like you can dream up a ton of nightmare scenarios. And biggest one you hear is what if the toilet's running all night or you get a toilet call at 2 a.m.? I think a lot of the scare tactics and the fear in real estate is over exaggerated. There's not as many high cost issues that can really come up. I mean, even like I was just dealing with trying to get tenants and it wasn't fun, but it wasn't like I was gonna, go bankrupt over it. So I think, and that's to your point, I have cash reserves and I have some money saved, and I wish I had more cash reserves in different, things. And that's why I'm looking into refinancing a little bit. But the point that I'm trying to make is I could see somebody wanting to buy cash because they think it's so much riskier to own real estate. But to your point, if you have the 20% leverage and you have a couple dollars saved, like five to $10,000 per property, you're really eliminating that risk. And like I'm gonna say, if you're so risk adverse that you think you want to put $200,000 cash into a property, you're probably better off saving 50 grand to cover whatever the heck might happen, and then just buying two to three other properties with leverage. Because what that 200 grand just buying the one like I'd almost like say if you have 200 grand, you're almost better putting it like into the S&P 500 than buying like a specific house. If you don't want any risk and to deal with any headaches and anything, like just put it into the market then. If you like the real estate, one of the main ways that you make money is dealing kind of with that risk and using leverage to your advantage.
Yeah, I mean another idea, kind of a pro for cash is like I've heard people on Bigger Pockets that, and I know somebody personally that their goal was to just have 10 rental properties paid off, and it's a lot less work. Um, so let's say you have 10 rental properties paid off, you could maybe manage them yourself, right? So you're going to save some money on management fees versus if you have 50 rental properties leveraged, the amount of stress that comes with that is a lot greater. And so you're going to lose 10% of rent on your 50 because you're hiring a property manager, obviously. Um, and it's just a lot easier to manage a smaller portfolio, obviously. So your cash flow per property is going to be a lot greater on the 10 paid off rentals than the 50, right? That are 20% leveraged, we'll say, or the cash flow evens out, but you have 10 versus 50. I'm just saying it is the more you have, the more things you have to think about, the more expenses you got to track and have Excel sheets and manage. Even though you have a property manager, if you have 50 properties, you have to manage your property manager and make sure that they're doing things the right way. So, and then to your point on, again, playing devil's advocate, if there is a crash or a COVID where people lose their jobs all at the same time, you don't have any worries if you own your property cash. You don't have to pay a mortgage. So like, yeah, you're losing out on the cash flow, but like all you have to pay is your property taxes, your insurance, which is we'll say like, a couple $100 a month. Um, it's not like, oh crap, COVID hit, all my tenants lost their job at the same time and I have to cover 5 mortgages or 50 mortgages. Now, again, have some cash reserves to mitigate that, but I don't know. I am looking at it as, kind of trying to give both scenarios an equal shot, even though, again, mathematically, the fastest way to growth is to leverage to the absolute max.
I think what we're both saying at the same time is the end goal is to own paid off real estate and make a ton of money. And then at that point, if you want to put a HELOC and tap into some of that equity or take a loan out on property A, but then you got nine others that don't, like, I mean, the biggest thing about real estate that's like this huge value is to grow your net worth. And that's why we think real estate is so advantageous and using leverage with it because you're not like say if you make $100,000 in income, right? Like for your W-2 job. Well, now you buy a property that's bringing in $2,000, you're making $24,000 a year on top of it. So now your $100,000 is 124,000. Granted, you're not taking all $24,000 home, but my point is you have a $200,000 property that you just bought, so that's appreciating at 3%. So you're making some money there. You're doing loan pay down from that $24,000. So let's say you get another $4,000 or $5,000 in loan pay down for that year. And so now you're still making the 100,000 at your W-2, but you have this little side business, that piece of real estate that's also making you more money in three to four different ways. And because you're making extra money there, it's growing your net worth. And then because the government keeps like the other thing is like you have to just own assets in today's society because the government just keeps printing money and that makes our dollars worth less. And because our dollars are worth less, guess what becomes worth more? Assets. And because assets keep going up, it's better to own them. And like it might be 3% appreciation right now, but there's going to be times when the government prints extra money and you get that 5 to 7%, appreciation like we saw during those COVID times. And something else that's really crazy that I think Ty and I've talked about it before, but Brandon Turner and David Green discussed this. And rent today might be $1,000 a month, but then it's going to go up to 1,050, and then it's going to go up to 1,100, and then 1,300, and then 1,700. If you have a mortgage payment of $1,000 a month, maybe you're not even cash flowing year one. But by year 30, if you kept that property, rent's probably $3,000 a month and you still have $1,000 mortgage. So there's just a lot of benefits to owning, real estate portfolio and rental properties. And then using leverage is going to be the fastest way to grow your net worth. And like at that point, once your net worth is there, you can change your mindset and do whatever you want. Like I don't know if I'm 100% there yet, but something I've thought about is like taking out a loan on one of my rentals and then paying off my other one between cash and and so I could have a paid off rental. Like I don't know if I would do it, and if I did it, I'd probably then get a HELOC for most of that and use it as like leverage to go buy something else. But there's certain like once you have to buy the real estate with leverage, in my opinion, to get started to grow your net worth, and you'll get there much faster. And that's what I think Ty and I both agree on is the quickest way to build wealth is using leveraged real estate.
Yeah, yeah, I mean, you can start to think about different options once you have a portfolio, but you're not buying your first rental property cash, right? I mean, yeah, sure, maybe if you make 500 grand and you can save 100 grand a year, then like good for you, go buy it cash. But most people, that's not their scenario. One couple points. Interest rate obviously plays a huge factor into this, right? I have a 3.3% rate on this house. I also have a property with an 8.8. So I'm never paying this one off early. I'm never making an extra payment or extra principal. But the 8.8 mathematically starts to make a whole lot of sense to pay that one off early, right? Or to buy that one cash. So
Or to
that
refinance
obviously,
and leverage more money and buy something else. But
yeah, I mean, I hope to refinance it. I probably won't cash out because over the last 2 years with an 8.8% rate, you've basically paid nothing in principal pay down. So my balance is like the same. But so yeah, that's obviously a big factor. If you have a 15% rate, it's a no-brainer that you want to pay that thing off as quick as possible. If you have a 3% rate, it's a no-brainer that you will borrow money at 3% all day.
so
Same
one
thing.
thing I want to touch on with you talking about the interest rates, because that's something that one of the main arguments that I have with my buddy is he hates paying the bank and like thinks that paying the bank any amount of interest is the dumbest thing you could ever do. And it's like, all right, I'm getting $1,000 a month, but I'm paying the bank $200 a month in interest. Like, yeah, the bank's getting $200, but at the same time, you're making money in so many other ways that it's
Yeah.
okay to pay the bank that $200 a month. And that's the concept that is very difficult for him to understand. It's like, no, you're stupid because you're paying the bank money. It's like, yeah, I'm paying the bank money so that I can make more money.
Yeah, but the opportunity cost is so much greater than the amount that you're paying the bank per month. So yeah, you might be paying them, we'll say $500 a month in interest, but you're generating $1,000 a month. So that sounds like a $500, pro in my book. But again, one thing I mentioned, like I had this idea to pay off a property, and that probably won't happen anytime soon. And I would definitely be slowing down on how much I buy, new properties if I did decide to do this. But I don't know, something about it was just like it's my lowest balance. And actually, to Dave Ramsey's point, when I'm thinking about paying off a property, for some reason, I just wanted to pay off the one with the lowest balance. And it's not the one with the lowest interest rate. So I have one at 8.8. That's not the one that I'd want to pay off. So, like, this kind of agrees with the whole debt snowball thing of pay off your lowest balance regardless of the rate. Now, the one that I'm thinking of still is like a 6.5% rate, so it's not good. But I was like, dude, if I paid this off, my right now my cash flow goal is 3 grand. If I somehow paid that off, that's my cash flow goal in one property almost. So like how sick would that be just to have 3 grand from one property? And then that's 36 grand a year, to buy more properties with. But I could instead buy three other properties with 20% down. So like obviously I'm not even close to like paying it off. I just had an idea that it would be cool. But yeah, I mean, I don't know if I'll do it, but there's also other, you don't have to do a 30% loan. Like you had a lot of 20-year loans, or sorry, 30-year loan. You had a lot of 20-year loans with your investment properties, and like after 5 years even, you have so much equity that like it again, the more you have, I think the longer you do it, more equity starts to become more desirable versus just constantly uh doing cash out refinance HELOC, like maximizing your leverage. I do think it starts to slow down. And not saying I'm at that point quite yet, but it's starting to feel a little bit enticing, I guess.
Yeah, I think the closer we get to the end game of trying to get a certain amount of, monthly cash flow, whether it's 3,000, 5,000, 10,000, paying off property is going to help you get to that number significantly quicker. But again, like, I think my overall argument is just trying to talk about growing your net worth. And I think that will always happen faster and better with leveraged real estate. Like, there's no way that buying a property cash will outperform using leverage to buy real estate and to grow your net worth. That's the main point that I was trying to make to my buddy that I'm not getting across. And he's bringing up a lot of things that you're saying, which are all fair points. And I think at the end of the day, personal finance is personal for everybody. And there's certain risks that some people are okay with, and there's other risks that other people aren't okay with. And that's all completely fine. And I know I just said at the end of the day, but overall, what you need to figure out is what is your final plan? Where do you want to be? And what is that cash flow number as far as like where you want to retire at? And if it's $10,000 a month, okay, great. You need $2.5 million saved at 60 so that you can live off of the 4% rule. I hope my math was right there. And if it's real estate related, you're going to need, let's say, 10 properties cash flowing $1,000 a month to get the same $10,000. To me, buying those 10 houses is a significantly easier way to get that to that $10,000 mark. So my goal is to grow my net worth as much as I can until I can turn the equity into cash flow. And whether that's using equity to buy more properties to grow so that eventually I can use that equity to pay off certain properties that I own, that's kind of my strategy right now. But you have to have the end goal in mind, and whatever that is going to be personal to different people. And so if your end goal is to get as much money as possible, great, good for you. Like, I don't want to live that lifestyle. I don't want to be the richest man in Babylon. Like, that's not what I want to be. I want to live my lifestyle that can give me freedom to see my family, to travel, to have a great life with kids and Sarah. And that's the life I want, and real estate can get me that lifestyle. And so that's why I'm so pro in using leveraged real estate right now to grow my net worth.
Yeah, I mean, yeah, again, mathematically, there's no argument, right? Because you're getting appreciation on 4 or 5 properties versus one. So again, wealth comes from appreciation and loan pay down, not necessarily cash flow. A lot of people say that. So yeah, I mean, and if investment loans offered 5% down, I think me and you would do it in a heartbeat, right? like,
Yeah.
like we would for sure put down 5% maximum leverage, 95% loan to value on investment properties.
Well,
But
100%. I haven't even talked to you about this, but like, I'm almost debating trying to see if my mom can qualify for like a 2 or 3K loan and put her into like a quadplex at 5% down and co-sign on the loan with her so she can get into a house, and like I can kind of complete like a 5% 2 or 3K loan rehab with her as the primary resident, so I could take advantage to your point of like putting low money down, getting a rental property. Obviously, the main goal there is to help her out in, her living situation as well and get her into a different house. But to your point, like I'm thinking of ways that I can try to leverage 5% down to buy real estate.
Yeah. Well, I mean, it's tough other than living there, but I've heard that strategy on Brandon Turner's podcast. This guy, he did that. Like he co-signed for like his sister and his brother and his mom, and he bought like four quadplexes in like 3 years with 5% down each. I don't really know how it works with like the co-signing because obviously they're the primary owner, so like you almost just have like a handshake agreement with them, right? Like, oh, I get all the equity when we sell or whatever agreement you come up with. But yeah, I mean, you can do that as long as the primary person is living there for a year. But yeah, I mean, it's tough. But again, you do start to get to a point where the properties that you own generate the down payment, even the 20% down on the next properties, and things start to exponentially, increase. Whereas like buying cash, it's just a lot longer, right, to save up that 100 or 200 grand, whatever your market is. I mean, we're using like our market, a rental property again, 250 to 300,000. It's like I don't know. It seems completely unreasonable for most people to save that up for their first investment property.
Exactly what makes personal finance personal. If you have great W-2 income and you can afford to buy a house cash one per year, that's not a bad strategy, right?
Yeah.
Like you can make a ton of money doing that if your W-2 income can support that.
Well, and
But,
also like
but
chances are if your W2 income is that high, you're spending a lot of time and energy on your W2 and you should be. Like if you're making 500K, a million, whatever, you should be focusing on your 401 or sorry, your job. You're not going to make $1 million in real estate investing like starting from scratch or even flipping houses. Like you should be focusing on your W2 if it's that high. And so yeah, if you just want to go hands off, basically buy a place cash, get a property manager, like I'm pretty sure a lot of extremely wealthy people do that. They basically have like a real estate manager, right? That they're just like, yo, go buy real estate. They buy cash. Like they don't really, they're super not involved. And yeah, that's a totally fine strategy. But most people are not making 500, $1 million a year where they can save 100, $200,000 a year.
exactly. So it makes it personal to certain people. And if you're making that money and you can buy a house cash every year, 2 years, 3 years, again, come up with that game plan of where you want to be when you retire and break down that strategy. Okay, I want the $10,000 a month, or I need it to be $20,000 a month. Well, now if you start buying houses cash and you're making $1,000 a month off of all of them, well, now you need 20 of those houses. So for the next 20 years, that's kind of your game plan to buy them cash. And if you're don't want to deal with the risk because of having a stressful W-2 job, that's completely fine. But you're not going to grow your net worth as high as you could if you used leverage. Granted, this person might be fine in that scenario, right? But they could grow even more buying 5 houses a year. They could probably retire in 3 to 4 years versus one house a year for 20 years.
Right. But again,
There's risk and other factors
and
involved.
should they be focusing on buying 5 houses a year when they're making $1 million at their job? Probably not. It's like take that money when you're making it and focus on that. But and like to that point, I hear a lot of people, you know, we quote David Green a lot, but like a lot of people will say like, "Hey, I want to buy real estate," or like, "Hey, I own a business and I own a contracting business or whatever. I sell shirts and I make 200 grand a year. How should I buy real estate?" And sometimes people are like, dude, focus all your time on growing that business and make 400 grand a year or 500 grand because that is going to make you money. Like real estate's not you know, you don't make money quickly unless you're flipping, but still, I mean, like if you create a product for a company and sell that product, you're obviously going to make money a lot faster. So, there's a
The,
lot of
the,
different factors.
the $200 to $500 a month in cash flow with today's interest rates is not going to be necessarily life-changing money for almost anybody. And that's like one of the things Dave Ramsey does talk about a lot. And in my opinion, he's kind of rude about it, but he'll say anybody using leverage debt isn't making any money because all of the extra cash flow, there is none of it. It all goes to expenses, repairs, and this and that, and you're really like losing money year over year. I don't 100% agree with that. You definitely do make money, whether it is just at 200 bucks or whatever it is. There's some sort of positive cash flow, but it's not going to be life changing at that point. The bigger things are just the loan pay down and, the
Yeah.
appreciation and the other ways that you make money in real estate so that you can eventually, be in a situation where you have a ton of equity. And then it's, do I sell this property? What's my return on equity on this property? You can play like different number games. And like, so Ty and I are going to get into a scenario soon where we kind of did two different strategies. And it just really shows how using leverage can grow your net worth a lot more.
Yep. Why don't you go ahead and share? Um, and while you're bringing that up again, like the math doesn't lie. There's no way around it to argue that mathematically leverage makes sense, but there's no error multiplier in this calculation. So again, just to tell you where Dave Ramsey would come from, that's what he would say.
So we use ChatGPT a little bit to try, and it's actually been such a cool tool for investors. Maybe Ty and I can do an episode on that. But things that would take us forever to put into a calculator and try to calculate this, and like I'm sure Ty and I were up till like 3 a.m. just arguing back and forth and like using calculators trying to figure this out. Now we can do this in like 12 minutes with chat. It's honestly insane. So the question that we asked it was, which strategy builds more wealth and cash flow? Scenario one, buy houses in cash every 5 years. And then scenario two, buy one house per year with 20% down. So leveraging at a 5% interest rate. The strategies are going to be over a 30-year period. And then we kind of broke it up to 5, 10, 15 years as well. So you can see the journey throughout the process. We said the houses are going to be $100,000 each. Rent is going to be $1,000 a month to start. But again, we talked about it earlier. It's going to increase at 2% annually. So from $1,000, it's going to go to 1,050 and 1,100 and keep going up year over year. 3% annual property appreciation, which that $100,000 is then going to be 103 and then 109, and it's going to keep growing that way at the 3% each year. And then we saved 40% for operating expenses, whether that's maintenance and property management, taxes, insurance. Yeah, all of that is kind of included in the 40% operating expense. So the leverage investor is going to use the 20% down, financing at a 5% interest rate. And so here, when we look at this, the cash person, after 5 years, they're going to have one house, $103,000 in equity because their property appreciated at that 3%. And their cash flow is going to be that $612 a month. So they're taking that $1,000. They gave it the extra 2%, so it's at 1,012 for this rent example, and then minus 40% in operating expense gets us to roughly $612. Where the leverage house investor, they're going to own 5 houses by year 5 because they're buying them at 20% down. So they're kind of using that same $100,000 and they're buying one house per year. They're going to have an equity of $166,000. So even though they're putting 20% down, and like Ty and I said, so they're going to have loans for 80,000 because they have those 5 properties. They have an extra $100,000 just in that, but they're getting the loan pay down, the equity appreciation on 5 properties versus one property. That's where they're going to have a little bit larger of an equity at $166,000.
Yeah. Looks like also that the cash buyer didn't buy his first property for 5 years because you have to save, let's in this scenario, $20,000 a year.
Yes.
So he missed out on 5 years of potential cash flow and appreciation. So like his equity, he only got 3% appreciation for 1 year because he basically saved up money for 4 or 5 years. Whereas the leverage, you're buying a property every year, so you have 4 years just to start of appreciation and cash flow that the cash buyer did not have.
100%. And that puts this guy's cash flow for the leverage equity at 1,038 for year one, which is roughly $400 a month higher
Year five.
than what?
For year five, not year
Yeah,
one.
by year five. And I like the point that Ty brought up is that's what also adds to the leverage value is you can buy a house sooner using leverage. If you're going to buy cash and you have to wait a year to 2 years to 5 years, you're losing a bunch of opportunity cost. And in this example, if you're like, and then on top of that, like something Ty and I didn't talk about too much is like the experience. Who's going to be the experienced and better investor? Like, yeah, this guy's grinding at his business, saving $100,000, buys one house cash. Takes him 5 years to do it. Maybe he researched the heck out of the market for 5 years, but guess what? If he bought at the wrong time in the market, he's kind of screwed. He's buying at the top of the market. He like interest rates. Well, I guess interest rates aren't going to bother him because he's paying cash. But my point is the leveraged investor that buys one house per year for 5 years, he's probably going to be a significantly better real estate investor. And so he'll probably be buying some stuff at better prices, better deals. And these examples aren't going to take into factor like, okay, I have some loan pay down. I'm going to re-leverage that debt and buy even more houses. And like, again, these are just more cookie cutter examples.
Yeah,
But go ahead, Ty. You have
that's
something?
that's actually a huge thing to point out is like if you're buying cash at a way less frequent rate, you save up for 5 years, you're like, well, I hope this works out, right? The contractor doesn't know who you are, the realtor, it's your first time using him. 5 years go by and you're like, everyone forgot who you were, and it's like real estate is all business is a game of relationships, and like it's really tough to build relationships when you're using somebody every 5 years. So, I mean, that's an awesome point. Is yeah, you're gonna be. I mean, on year 10, you're gonna have 10 houses, so 10 times experience versus 2 houses. So I guess that's 5 times the amount of experience. But still, those relationships, and you're using somebody every year, and you're on your 10th deal, you're probably gonna start to be at the point where you're getting a lot of good deals. Whereas buying a place every 5 years, like good luck getting a great deal because again, you just don't have the experience. So that is a huge factor into this that Chad doesn't really know about.
Well, and chat's tough to put these examples together, but I would argue that, I mean, 15 and 30-year examples, they're great. We'll get to them in a second. But if you took 10 years and you bought one house per year for 10 years and you didn't necessarily refi, like do anything like cash pulling out anything, after you did that for 10 years, you'll probably have enough equity in those properties to refi a couple, pay off a couple, probably bump up your cash flow, maybe sell a couple. Like if you did that, the amount of equity, like with that 457,000 of equity, there's a lot of opportunity to like change a lot of things up and really like I'm not saying you could retire at that point, but I don't think you're that far away if you have 10 rental properties to work or get to whatever your goal could be. Right? That just gives you a lot of power. Versus the other example, you have the two houses for roughly 222K. Still have some power, but you got double your net worth in 10 years by buying one house per year.
Yeah. Yeah.
Uh,
And then, I mean, 15 years again, it's not only double, now we're almost at triple. And in 30 years, we're at 3.5 times the amount of equity. So it actually starts off, it could start off a little slower. Like usually you'd have a less cash flow, but it's an exponential growth versus kind of like a linear growth with buying a place cash. So four times the amount of net worth and 6 times the amount of properties. Right now, five times the amount of properties. But again, that brings a level of stress. But yeah, that like to your point, there's so much you can do and you have 10, 15, 20 properties, whether that's refinance, sell, 1031 exchange, pay some off. Like maybe you're taking that cash flow and hitting your lowest property, all that extra money per month, and you pay it off, and then you pay one off every year. Like there's just an infinite amount of possibilities where with 3 houses there's not a whole lot you can do.
100%. It's pretty eye-opening when you look at it this way, that the leveraged example is going to get you significantly more cash flow and raise. I mean, cash flow, maybe that wasn't the best example. I meant to say equity. You're just going to get so much more equity using leverage because of the loan pay down that, and then the appreciation on a lot more properties, that it makes a lot more sense to go leveraging this way. To your point, the biggest difference is the risk. You're going to have more risk using the leverage, but it's not like we're buying houses with 5% down or 10% down, even. These are rental properties all at 20% down. And so, because of that, the market has to drop significantly for you to be upside down on those loans. And yeah, repairs and expenses and maintenance might come into play. And so, if you have that $5,000 to $10,000 of cash reserves per property, you're setting yourself up for good success in case if an issue does arise.
Yeah.
Um,
And I've also heard from like more experienced investors that actually the more properties you have, your risk kind of goes down because you're generating enough cash flow per month to cover a few properties that say didn't pay rent or you need to replace a roof. So like if you have 50 properties and you get hit with a $20,000 roof expense, chances are your cash flow covered that in 1 month. Versus if you have one property and tenant doesn't pay, and that same month you have a roof expense, you don't have any other sources of income to cover that tenant not paying. So the only caveat there is what happens if all 50 don't pay at the same time. That's pretty extreme. I guess you could argue that that could have happened during COVID, but I do think that the more properties you have, you need, in my opinion, less reserves per property because the cash flow per month covers those potential expenses. And you're not going to have 50 roofs replaced in 1 month, right?
yeah, I think once you get to a certain amount of properties, I mean, roughly $20,000 to $50,000 in reserves, almost future proofs whatever potential hiccup you might have. I mean, obviously, you'll have access to funds in different ways if you need it, but I think if you could have 20 to 50 liquid in some form or fashion, that's really kind of that sweet spot. And like that, you don't need that much more than that to really eliminate a lot of the risk. That's one of the points we made earlier. If you're super scared about risk, go ahead and throw 50K into a savings account, 4% interest rate, have it sit there. And if something happens, somebody doesn't pay rent, you pull from that. And that 4% is probably equaling whatever scarcity mindset that you have as far as the risk is going to be.
Yeah. So again, this is the math doesn't lie. You won't find an example where leverage grows slower. Mathematically, but I also had an example. It's basically the same thing. I'm not really going to go in depth about it, but mine was just that somebody buys one property and then somebody else buys four properties. They don't buy anymore. They just set it and forget it. And in 30 years, basically the person that bought four had three times the amount of net worth. So basically the same thing as what Tommy shared. Again, you can run an infinite amount of scenarios and you're going to see kind of the same thing. And again, this mindset, these principles, they go towards the same as paying off your mortgage early. Say you already have a property, depending on the rate that run these calculations and see what your net worth will be in 30 years if you pay it off early.
And these are the examples I tried sending to my buddy, and in return, I just get Dave Ramsey videos sent back to me saying that I'm wrong and Dave's right. And I'm like, dude, I can't run the numbers any way to make cash buyers beat leverage buyers. It's not physically possible. Leverage is always going to win, even if I'm paying the bank $200 a month, and even if I have to fix a broken toilet. Leverage real estate is always going to beat pretty much anything.
Yeah. So I think we'll wrap up with that. Again, everybody's kind of in their own scenario, so I'm not going to say every person should maximize their amount of leverage, but when you're starting out, typically more leverage is going to allow you to grow faster. And as you get closer and closer to retirement age, you probably will start to increase your equity, lower your leverage, and lower your risk. And at least that's what my plan is.
For sure. Awesome. Well, great episode. Thanks everybody for tuning in. We'll see you next week.
See you later.